Most people hear the word yield in crypto and immediately think one of two things: either free money or... This sounds risky. The truth is, it's neither. Yield isn't magic, and it isn't a scam by default. It's structure. And if you don't understand where yield comes from, you're not investing, you're guessing. Today, we're breaking down how passive crypto yield actually works, using Binance Earn as a practical example. Not to hype it, not to push it, but to understand the mechanics behind it. Because once you understand structure, you stop chasing numbers and start evaluating systems. Let's simplify this. Yield means you provide capital, someone else uses it, you get compensated, that's it. Banks have done this forever. You deposit money, they lend it out, they earn interest, you get a portion. Crypto didn't invent yield, it made it more visible. When you see something like 4% APY or 8% APY on a platform, that number represents compensation for providing capital into an active financial system. So the real question is never, how high is the yield? The real question is, where does it come from? Because yield always comes from somewhere. Always. There are generally three main mechanisms behind most yield products. 1. Lending. You deposit your crypto. The platform lends it to borrowers, often traders using leverage. Those borrowers pay interest. You receive part of that interest. Supply and demand determine the rate. If borrowing demand increases, yield increases. If demand drops, yield drops. Simple structure. 2. Staking. This applies to proof-of-stake networks. When you stake, you help secure the blockchain. In return, the protocol distributes rewards. Those rewards typically come from network inflation, transaction fees, different mechanism, different risk profile. 3. Structured or liquidity-based products. Some yield products use more complex internal strategies. This might include liquidity provisioning, funding rate arbitrage, capital allocation mechanisms. These can offer different yield levels, but they rely on active market conditions, more moving parts, more variables, which means more to understand. Binance Earn isn't one single product. It's more like a framework. Inside Binance Earn, you'll typically see flexible products, locked products, staking options, occasionally structured offerings. The key difference? Liquidity versus commitment. Flexible products allow you to withdraw at any time. Lower yield, higher flexibility. Locked products require you to commit capital for a set period. Higher yield, lower liquidity. That trade-off is important because yield isn't just about return, it's about structure, flexibility versus compensation, access versus optimization. And once you see it that way, you stop comparing percentages and start comparing design. Passive income is one of the most misunderstood phrases in crypto. Passive doesn't mean effortless. It doesn't mean risk-free. It means the system operates without your daily involvement. But you still need to evaluate counterparty risk, platform credibility, asset volatility, liquidity needs. If you're earning 5% on an asset that drops 25%, the math still matters. Yield only makes sense inside a broader allocation strategy. It's a component, not a shortcut. Binance Earn isn't for someone trying to double their capital next week. It's generally more relevant for long-term holders, investors with idle capital, people who already understand the asset they own, those building structured exposure rather than constantly trading. It fits into a bigger system. You might trade a portion, hold a portion, allocate a portion to yield. Different buckets, different functions. That's how capital management evolves. Not through excitement, through structure. If you want to see how the interface works and explore the different product categories yourself, I've placed access in the description. Not as a push, just as a reference. because it's easier to understand a system when you can see it. The most important takeaway isn't the percentage. That number changes. The important takeaway is this: yield reflects activity. If capital is being borrowed, staked, or structured, value is being generated somewhere, and you're being compensated for participation. Once you understand that, yield stops feeling mysterious. It becomes mechanical, and mechanical systems are easier to evaluate than hype cycles. Crypto doesn't need more excitement, it needs more clarity. And when you start thinking in systems instead of percentages, you move differently, calmer, more intentional, more structured. That's the difference between chasing yield and understanding it.